I don't think so. I don't think so. As a matter of fact, you look at businesses, and particularly in the tech area, which is very volatile and a good indicator of things to come. But they had immense hiring during the pandemic, and I think so far this year there've been 137,000 job cuts in the tech sector. So they've really reversed gears, and I think what's happening is that there is a lot of unwinding from the pandemic. Now, in the meanwhile, of course, you have some industries that are looking for more people, but you look at a lot of the indication, the people are more inclined to stay with their jobs. Quit rates are down. People don't want to quit because they may not get new jobs. You look at job openings; they have declined, and the labor markets are definitely getting softer. So, you as usual, you can't look at any one set of weekly numbers and conclude what that's going to happen. But I think there's a pretty clear pattern of softening job markets, and that's really the main reason I think that the Fed has shifted gears from this engraved in stone target of 2% inflation to now cutting their reference rate by 50 basis points, in the sense that it suggests the Fed is really panicked, because they had this engraved in stone 2% inflation target, and all other major central banks in the West had the same 2%. And of course, now we've seen cuts in bank rates in Canada, in the UK, in the European Central Bank, and now the Fed. And the fact that they not only reversed gears before inflation got back to the 2% that they had targeted. Before that, the fact that they went 50 basis points rather than 25 tells me they're pretty worried about the labor markets deteriorating and not just stopping at go, but going into recession. Some of it is, but the numbers, if you look at them as reported, it's a relatively minor amount growth of the labor force, less than 1% from immigration. But the point is that immigration is a soft number, because there's a lot of illegal people coming into this country that probably don't get counted. And of course, another thing that is confusing it is that people have multiple jobs. Now, supposedly the Department of Labor Statistics, Bureau of Labor Statistics, corrects for that, but you don't know whether they take them all out. In other words, that they count people with two jobs as two people. So it's the whole statistics is a little tough to interpret. But I think when you look at not only the unemployment rate, but you look at the job openings data, you look at the quit rates, you look at a whole host of labor statistics, it says that labor markets are definitely softening. And I think that was primarily the driving force behind the Fed's cut of 50 basis points. Growing concern, and of course it's a two-edged sword. One is the increase in the unemployment, softness of labor markets, and the other is that inflation has come down. Now, inflation is still above the Fed's target. It's running about 2.5%. The Fed had this vehement desire to get it down to 2%. And by the way, I don't know why they picked 2%. They've never really explained that to my satisfaction. My speculation, and I use that word deliberately, is that they were worried about deflation back before the pandemic. That was the concern. Was they're going to slip into deflation, and in deflation, what happens is that you get a self-reinforcing downward spiral, because people are waiting for lower prices to buy, and inventories pile up, excess capacity pushes prices down. Suspicions are confirmed, people wait even longer. And my suspicion is that the Fed was so fearful of that they wanted to have a cushion. They wanted 2% inflation just to protect themselves against deflation. But for whatever reason, the Fed and all the other major central banks zeroed in on this 2% target and were vehement on it until just really a few months ago. Well, some of the other central banks started well before the Fed, a month or two earlier. But I think that the abandonment of that whole strategy, and they've never really explained why they did that. But I think it's clear that they're worried about the labor markets. The upcoming election gives them pause because they never want to look as though they're being swayed by political considerations. So if they're going to cut again, they're going to have to do it pretty quickly because we're getting 5 weeks away from the election. So they really don't have much time. But they could cut again. If they did, I think you'd only interpret that they're getting really scared. Otherwise, they probably would wait till after the election, late November or December. It could, if the economy continues to soften and unfolds into a recession. But I would caution our viewers that the forecasting record of the markets and of the Fed participants are not very good, to put it euphemistically. So I never get too excited about their forecasts because they have not been, they haven't been close enough to be a very reliable guide. It's a different situation. I mean, back then, of course, the culprit was the subprime mortgage lending, and it was a very, very pervasive malady in the economy. And people were convinced that they could buy houses, take out big mortgages, over 100% of the cost of the house when they added in home improvement loans, and they never have to pay a dime because the price of the house would escalate to the point they could refinance before the first mortgage payment was due. I mean, it was really a fairyland. We don't have anything like that now. We do have problems with commercial real estate, as I'm sure you're aware. The office market is really in trouble because people have been working from home. There was a lot of excess building. This is an area, like all real estate, which is highly financially leveraged, and that means it's very easy to get overblown in that area. But that's not big enough. Yeah, there people are getting hammered on this, but it's not big enough to, in any sense, rival what happened back with a subprime mortgage. So I think it's hard to use that as an example of what's going on today. It could be a distinct shock. Now, like in the 07-09 major recession, it was a collapse in subprime housing. If you go back to 2000, it was a problem with growth stocks, and they were going to the moon. You can have these special factors. I don't see any major trigger, but you have had times when it's just a matter that things get top heavy, and that could be the case now. As I say, you've had a lot of speculation. You look at all the Bitcoin area, the Magnificent Seven, the Nvidias, and so on and so forth. You've had a tremendous amount of speculation and a narrowness in the stock market, which to me is a very distressing sign, because it says people are not interested in the general economy. They're not buying the bulk of stocks. They're buying specifically speculative areas. So it's one of the things that says to me that maybe there is a sleeper weakness in the economy here that just isn't completely revealed, but will be.